Forward Guidance is brought to you by VanEck, a global leader in asset management since 1955. You'll be hearing more about VanEck ETFs later on, but for now, let's get into today's interview. I'm very pleased to welcome Adrian Helfert, Chief Investment Officer at Westwood Holdings Group, to Forward Guidance. Adrian, welcome.
Thank you for having me.
My pleasure. Adrian, so you work on a lot of multi-asset investments, so I think asset allocation between stocks and bonds. Later on, I want to ask you, what is your allocation now? Are you favoring stocks over bonds or bonds over stocks, and why? But first, I wanted to start off, in the asset allocation process, how do you think about stocks and bonds and the role that they play in a portfolio? And then we'll get into, why you might favor one or the other. But for start off with the building blocks. What are the upsides and downs, pros and cons of stocks and bonds?
Yeah, great question. And that is the place to start, certainly. And there are two real houses or schools of thought here. One is where I stand, which is both of them serve as total return opportunities. Each of the categories serve as total return opportunities. And you have changing correlations over time to how those mixes fit together. The other one is that bonds will always serve as the buffer or the haven, and stocks will serve as your total return opportunity. You only have to look at 2022, where the ag was down 13-ish%, and stocks were down almost 20%. You look at the S&P 500 and realize that your safe haven didn't work. So we think more in the realm of many of these categories are total return opportunities. We look at bonds as having good income and potential for capital appreciation. We can talk about the plethora of categories, whether it's corporate bonds or mortgages or U.S. treasuries, secured and unsecured, high yield and investment grade. Of course, there's a large amount of potential there, all of which are total return opportunities. And the equity side is, of course, also very diverse in its orientation. And these are total return opportunities. We are fundamental investors. That's where I come from. So I'm looking at each of these individual investments as a potential for, I'd like to see a good total return or a capital appreciation potential. Income is, of course, important as well for many investors. And for us, we find that important. It's an orientation in many of our funds to have that. So bonds provide usually more of that, but there's both components. And the mix of that, the middle of that is, are these things correlated? You can take a view on when they should be correlated and when they may not be correlated, or they're less correlated. As I say, you have to look at 2022 and realize that that latter party of bonds are always your safe haven doesn't always work that way. So we believe more in the owning across a cross section of opportunities, understanding the correlations change over time, and looking for total return in each individual asset class.
Is there something about bonds that they're maybe a little bit more safe that justifies their lower expected return? And I might ask, do you agree with the claim that bonds are a lower return investment than stocks?
Oftentimes I tell investors that bring this up, of look at the volatility and the return volatility of the 30-year U.S. Treasury. Do we think that the U.S. Treasury is going to default in 30 years? Of course not. This is what we would call a risk-free asset. Is it possible? We have to look at discussions and think, yes, it's possible, but it's a risk-free asset, but it has a lot of volatility based on economic differentials, and as much volatility as many equity asset classes. Bonds also, on a total return basis of getting your bond return right, can provide significant upside. High yield bonds, which are corporate bonds that are lower in quality, of course, than investment grade, but still many large companies that you know and have heard of and buy their goods from Walmart and elsewhere, returned 13% last year. That's not far off of what the equal weighted S&P 500, the average of all the companies, returned last year as well. So bonds and getting that good selection right can return as much as equities. On the whole, you also get that kicker of usually more income from your bonds as well. When things are going well on bonds, you get a little bit of maybe spreads, or that default compensation reduces. Maybe your rates go down as well, your bond prices go up, and you've got a kicker of a 5-8% yield, depending on which bond you look at. The opposite is also something. You get a little bit of a buffer from income when things don't do so well. that you don't have in equities. Bonds and equities have both their attractive total return potentials. I don't subscribe to bonds are always just a safe haven that can't return as much as equities.
Do you think it's that bonds and stocks have a return profile that's different, and like the probability distribution is different, and you want to blend them together to create a portfolio that has a balanced outcome on right, left, center, tail, everything?
For sure. And they have different investment paradigms as well, when you might want to be in one versus the other for that asymmetric versus symmetric profile. Just kind of repeating what you said nicely there is equities have generally a symmetric profile. The S&P 500 goes up 1%, it goes down 1%. You've got a little bit of or 5% and down 5%, depending on your time periods and how much volatility. And you have a smidgen of dividend yield that is offsetting that, but that's not what investors are invested there for. So it's kind of a symmetric return profile. Your upside downside capture, as we would talk about it, is about 100. Where the bonds and the bond side of the house, it's kind of an interesting thing that the Federal Reserve has pushed in some ways in a portfolio balance channel, pushing you into asset classes that have better upside versus downside by pushing interest rates up. In a zero interest rate environment, they look a lot like equities in that return profile. You don't have much compounding yield to offset the downs and to enhance the ups. Where in today's environment, a high yield bond, for instance, that yields, say, 8%. Well, let's say your default compensation goes up because the company becomes a little riskier, i.e. spreads widen. Let's say rates rise, risk-free interest rates rise, and the old seesaw of when yields rise, bond prices go down. So your bond on a price basis goes down. You're offset by a good 8% of buffer that you earn over the course of the year on that coupon yield. And so that's the buffer on the downside that you get as a sweetener on the upside as well. So your upside versus downside capture on bonds increases as rates rise, just mathematically. And so it's something I think that the Fed is underappreciatedly pushed in their portfolio balance channel. When they rise rates, they take you a little bit out of riskier activity and put you in less risky activity. And part of the way they do that is saying, gosh, I find something that is higher interest rates a little bit more attractive than prospective risky activity. But it's also your upside versus downside capture can be better in bonds than in equities.
So with interest rates higher, bonds are less risky now than they were when interest rates were at zero.
With interest rates higher, bonds at least have, they may have a volatility, and we saw that in 2022 of they can be risky as far as a total return, but you have a little bit of a buffer to the downside for bonds. It makes them a little bit more attractive than in a low interest rate environment.
You run a multi-asset portfolio, have portfolio managers reporting to you. What determines your asset allocation between stocks and bonds and maybe some alternatives? What percentage is typically equities in terms of a range? What percentage is fixed income now? And where are you at now, or why? Like, are you favoring bonds over stocks or stocks over bonds relative to your firm's history?
Yeah, the last piece is really important. Of every investor is I think should be required to have a central objective. And it's interesting to say, as being in this business a long time, a lot of people like to say, I have no benchmark. Even if cash is your benchmark, you have a benchmark. You've got a central objective of what you're trying to achieve and how much risk you're going to deploy for your investors. And make no mistake, risk can be a very positive term. Investors want you to deploy risk to make improved returns over a central objective. And so our central objective would be, we have a plethora of funds, of multi-asset funds that have different objectives, but let's take it from the standpoint of we have one flagship fund, our Income Opportunity Fund, that is a central objective of somewhere between 30 and 50% equity, and the remainder, call it mostly fixed income, investment grade, generally fixed income. And so operating from that central objective, and I use that band because it's tactical as well. There are pure balanced funds that have that as your central objective and they don't move. And then there are risk parity funds that use risk as their paradigm instead. We use a tactical orientation to say, just as you're talking about, you can find bonds more attractive than equities at different times. And so as it stands right now, we've started to find equities more attractive than bond returns. Whilst I just told you about bonds have become increasingly attractive, at the same time, just 2023 is kind of the example there. Well, they may be more attractive in a higher interest rate environment, but if we see super positivity and well, that was a magnificent seven, but even some in the economy, then you could see your equity still outperform. We're coming into an environment that the Fed is much, much more likely to drop rates, provide more accommodation, push investors back out into activity that will allow more economic growth. That is a good environment for equities generally over an investable cycle. So we are finding more opportunities in equities than we are in bonds. So we've started to overweight our bond relative to a strategic objective, overweight our equities, at the cost of bonds. Now, there's a lot of subtext in there as well. As a long-term multi-asset investor and growing up a little bit in fixed income as well, of when we talk about a percentage of bonds, I always kind of chuckle because it doesn't make a whole lot of sense, because owning 60% of U.S. Treasury bills is a whole lot different than owning 60% of high yield bonds or 60% of 30-year U.S. Treasuries, because of the effect of interest rate duration or interest rate sensitivity, how much your bond price moves when the parallel interest rate curve goes up versus it goes down, or how much risky activity impacts you, so spreads widen or they contract. When I think about that, our actual targets aren't in percentages of fixed income holdings. They are thinking about the interest rate duration or sensitivity we have. Do we think bond yields or U.S. Treasury yields are going to rise or fall? Obviously, if U.S. Treasury yields are rising across a parallel interest rate curve across all maturities, then by the old seesaw of bond math, prices are falling, and that's bad for your investment. And then we're thinking separately about how much credit risk we hold, and the credit risk we measure, or the risk for that, is how much are we getting paid for the default compensation or lending to a company. And really, sometimes investors in my field get caught up in all the nomenclature, but it's kind of simple. And the simplicity is, as a bond investor, you're just a lender, and you have to think like a lender too. When you buy a Microsoft bond, you're lending money to Microsoft, and you want Microsoft to be prudent and become less risky and have less chance of going into default. I use Microsoft as an example because Microsoft could default while we are sitting here talking. That's extremely unlikely, as you and I know, but could happen. And because it could happen, you could get, if I were to lend to Microsoft for a day or two, I should get paid just a little bit of extra over lending to the U.S. Treasury, which is always thought of as the risk-free asset. So when we think about risk and how we deploy it, getting back to, we are overweight equities, but we are also, when we invest in fixed income, it's not the percentages. We've actually gone up a little bit as of the tail end of last year in our interest rate duration or sensitivity, and then recently reduced that a little bit further. So we actively manage our interest rate sensitivity based on the fair value of risk-free yields. And then we are separately looking and saying, how much credit risk are we taking? Is this an environment where we could see defaults rising of corporate bonds, or corporations having more problems, of financial conditions no longer being supportive, of systematic risk rising, in which case spreads will rise and our bond prices will fall as a result, all of things being neutral. So we've started to take down our spread duration or our spread compensation as a result of we see better activity in symmetrically invested in equities, where we see a supportive Fed pushing activity out to that spectrum. At the same time, we don't feel like we are as well compensated as we would like for the potential of financial conditions dropping and corporations having trouble meeting their liabilities.
So you think spreads are pretty tight, so you're not being compensated enough for that risk. You may as well go into equities and much lower risk bonds.
Generally, yes. I say generally because there's always we still own corporate bonds where we feel like we're overcompensated for the risk inherent. And so there are select opportunities. We see less and less of the select opportunities, to your question. And we look at it in multiple ways. Obviously, like the equity markets, you will look at spreads over time of the high yield spread on average being around 350 basis points on unsecured bonds. So 3.5% over your U.S. Treasury is about the extra compensation you receive for your high yield bond. But you also look at it, so how is that in paradigms of history? And we look at it on a histogram basis. I always find that one interesting, of saying over a 25-year period, how often do we sit in this bucket right now of being compensated 3.5% extra for the default compensation in high yield bonds? And what you find is about 80% of the time, it's more than that actually, right now it's about 86% of the time you're compensated more. Right now it's about 14% of the time this is about how much you're compensated or less, which means the majority of the time you're earning more for that kind of default compensation. It puts that economic framework in your mind of, well, are we in an average environment? Are we in an environment right now where there's much, much lower chance of a higher default experience, of financial conditions experiencing a closure? And we think that's less likely. We still look at as the Fed would say, the long and variable lags of interest rate policy are still concerning. And it's, I venture off course a little bit in talking about macro, but you look at the consensus expectations right now for the 12-month forward possibility of a recession. And I don't mean a technical 2 quarters of negative GDP growth recession. I mean, the National Bureau of Economic Research opines and says unemployment is rising, consumption is considerably lower, and we have negative GDP growth, and we're going to call this a recession, is 45% right now.
Really?
I find that pretty high and too high. I think it reflects in part a risk premium of recession risk, or a tail risk, that we're still looking at. The Fed hasn't turned yet, and the Fed hasn't officially gone to dropping interest rates, and we still worry about the long and variable lags of interest rate policy taking hold at some point. And so economists are still hedging their bets, if you will, by keeping a recession risk heightened until we really see the Fed actively turn.
What metric are you using when you say economists? Is it, you say 45% of economists are predicting a recession? Is it a quantitative model, or are they polling Wall Street economists? Because I might add, I think it was Bloomberg reported an economist poll in October 2022. My viewers who listen to this have heard me say this a million times, but the recession probability was assigned at 99%. So I might, if the real recession risk is 10%, you can't just go from 99 to 10%. You have to go to 45, go from third to second to first street.
That is, and I think the 99% you quote would be the implied recession probability from something like a 10-year U.S. government yield less a 2-year government yield right now, which is an inverted, that's what we call the inverted interest rate curve. And there's an implied probability of recession because it's long been discussed that that's one of the best predictors of a potential recession. Cam Harvey, actually, that I think you had on your show before, was one of the originators of that research that talked about that. And when that swings around, then that becomes, so we went deep into negative territory of the 10-year yield was much less than the 2-year yield, meaning potential for economic activity, if that's how you read it, coming down in the future, and a heightened monetary policy pushing down economic activity, thus you have a heightened recession risk. That's at 99% probability. The 45% that I reference is more it's all the economist consensus. So it's those economists that are anywhere from the finger in the air, this is what I think, to having their own model that does a bottom-up GDP analysis, and everywhere in between. But it's generally more fundamental in nature of a subjective rationale from an economist. So right now, and that's a good point that you bring up around the 99%, that reflecting a lot of indicators like what I just talked about, that we'd call the 210 curve, saying this inverted U.S. Treasury curve is telling us that we should be experiencing a recession, because for the past 7 times it has remained inverted for any reasonable period, we have seen a following recession. And this time we haven't. And we're starting to see us coming out of many of the leading indicators that have historically told us we're going to experience a recession. And gosh, I can't tell you how many times in the last 2 years I've read, well, because this indicator is now at this level, like the 210 curve, that means every time that's happened, you must experience a recession. It's nice to see some of those indicators doing a little bit the opposite now, and you're getting that opposite narrative. One of those is CEO confidence. CEO confidence has ticked up recently. And you might say, well, at this level of rise of CEO confidence, we've never experienced a recession immediately following. So it's nice to see the turn of events.
It's really interesting. And what did you say earlier about 86% of the time X outperformed Y in terms of high yield?
So this is just where spreads are on a histogram. So if you take all of the corporate bond spreads for the high yield universe and you put them into X period of time, they're in this range and this range, and so you end up with a somewhat of a skewed bell curve. And you say about 86% of the time, spreads are wider than where they are right now, and about 14% of the time, they're tighter. They're providing less default compensation than where they are right now. We're at that point right now where, as I said, for your default compensation, for how much you get paid for taking a risk of lending to a company, of lending to Microsoft, about 86% of the time you get paid more. So then you go question, you put that in relativity to other economic things and say, so are we in that environment right now of where, the top quartile of where the economy is going to improve? And the forward expectation for 2024 growth right now at 1.6%, I don't see that. I see the potential for downside risk.
Like gold did, Bitcoin is establishing itself as a macro asset that potentially helps hedge against the government devaluation of your money. Finally, you can easily access Bitcoin in a low-cost ETF with the VanEck Bitcoin Trust, ticker HODL. Search the ticker HODL in your brokerage app today. Visit vaneck.com/HODLFG to learn more. That's vaneck.com/HODLFG. Now the disclosures. Investing involves risk and you could lose money on an investment in the VanEck Bitcoin Trust, also known as the Trust or HODL. The value of Bitcoin and therefore the value of the Trust shares could decline rapidly, including to zero. You could lose your entire principal investment. For a more complete discussion of the risk factors relative to the Trust, carefully read the prospectus linked below. Thanks, let's get back to the interview. 86% of the time, high yield spreads have been wider. That suggests that you're not getting the best entry point in terms of valuation for the high yield market. How do you estimate valuations on the stock market? And I know you don't own the stock market. You own a somewhat large number of individual securities, but when determining how much stocks to own, as well as stocks relative to bonds, as well as individual stocks, do you have any histograms there?
It's a good question. Yes, we own individual stocks, and the one flagship I spoke about, we have 35 equities, and so it's a concentrated, high conviction portfolio that, yes, it does have allocation risk to overall equities, and so as an allocator, as someone that also thinks about the macro awareness, we're thinking about the valuation of equities as they play into that, even knowing that, yes, in that portfolio we do hold IBM, and that's driven by idiosyncratic or the company risk that goes up and down. On the valuation side of equities, one way to look at it is the same that others do, of how much you get paid per unit of earnings. So on the corporate bond side, often it's how much do you get paid for the risk of default. On the equity side, this is how much are you paying for a stock for a unit of earnings, or for its book value, or for its cash flow. Many measures differ by the sectors you're looking at, and cash flow, I think, is a very good measure. Price to book is an old measure that is less utilized now, in part maybe because we've become more of a technological economy that the book value of the assets is not as important as it once was. So we're looking now at forward price to earnings and price to cash flow being very meaningful metrics. And just highlighting the forward the price to earnings metric of it's underappreciated. I think that when you look at a stock valuation, if that's your chosen measure of thinking just price to earnings, whether it's a cyclically adjusted like a CAPE measure, Shiller CAPE measure or not, more often than not, I want to look at the forward price to earnings. And yes, I want a good feel for that forward estimation of earnings is a good one. But take NVIDIA as an example. And NVIDIA is not a stock that we hold right now in that flagship portfolio, but take NVIDIA as an example, where in May of last year, when NVIDIA came out with that extraordinary earnings report, that it felt like that part kicked off the AI revolution. First, you had ChatGPT that came out in March, and my son all of a sudden is doing his term paper on ChatGPT. And then in May, when NVIDIA came out and announced their earnings were going to be, their forward expectation was going to be significantly higher than where it was expected, because companies were coming in and buying new chips because they started to see the light from ChatGPT about 8 weeks earlier. There was a lot of chat about it. So NVIDIA went up 20% in the stock market. And I was a lot of chat about, well, how expensive it had gotten. That's only if you look at just the contemporaneous price to earnings. You start to look at what NVIDIA is telling us about how much money they're going to make of future earnings, so a forward price to earnings, and they got cheaper.
Mm-hmm.
Their estimation of how much they were going to make went up more than 20%. The price only went up 20%. The stock got cheaper. So is it really that surprising that it kept rising afterwards? I didn't think so.
Yeah, that is such a great point. You have people say, "Oh, the trailing multiple of Eli Lilly is 120," and it's like, well, I think they're rolling out Ozempic, and I think a lot of people are using that. So maybe the forward PE is lower than 120. May still be overvalued. I'm not making a claim on that, but a trailing PE when earnings double, a trailing PE is probably pretty useless.
Very much so. And then looking across markets, you do have to. We're in a market now with some behemoths out there. Those are the much discussed Magnificent Seven in the S&P 500, and that's one of the key metrics that every investor watches come across their CNBC screen 500 times a day, or wherever it is. So that's therein lies, when all eyes are on it, it lies a metric of valuation. But I talked earlier about thinking about an equal weighted S&P 500, not just the average S&P 500, and just delving further into, well, individual sectors clearly, but individual stocks and ways to adjust the fundamental characteristics of your index so it's not purely driven by a full index. Maybe it comes from my past as an old physics and math major of thinking about the difference between a mean and a median. And if you ever took your stats class, you heard a lot about knowing the difference between your mean and median. And when your mean or your average is well higher or well lower than your median, you've probably got some standout characteristics. And that's kind of where we are now, is the median of the S&P 500 is quite different from its mean. Then you should be looking at the valuation characteristics as well. And what you find is that stocks, by and large, I don't find them extraordinarily expensive right now. They are above an average, yes. But by and large, for a selector like ourselves that find individual opportunities that have revenue generation capabilities above the consensus of the market, or margin expansion, or new paradigms of product development that might lead to the next Ozempic, gosh, let me know when you find that one. Those stocks are not extraordinarily expensive. What has become more expensive, we believe, is the large market cap stocks that maybe are more expensive in two parts. One is because, yes, there is technological innovation, and I believe, in my humble opinion, that what we're seeing with artificial intelligence and machine learning is representative of a true change in paradigm that will lead to revenue generation potential and margin expansion and new product opportunities for what is the lifeblood of the U.S. economy, which is the small and medium-sized companies that also form the majority of our employment. NVIDIA, basically, back to NVIDIA, they ain't making all that money unless somebody else is buying those chips. A lot of companies are buying those chips because they see the potential for new opportunities of the future. And let's take, for example, a pharmaceutical that sees, not even a large pharmaceutical, a mid-sized pharmaceutical that is using AI to its benefit to compete with the larger ones, to find those new early stage drugs that might have some potential to use technology to go through protein folding techniques and find a next potential drug that they could put into phase 1 and phase 2, because you still have to go through the FDA, the artificial intelligence, isn't going to approve your drug for you. That takes a couple of years. So NVIDIA is, I believe, and many of these larger companies are benefiting because they are at the forefront of some of these capture potentials. NVIDIA is probably key on that, and that ecosystem that represents some of the other stocks that are the transistors and the wafer technology out there. The other companies are going to have a good opportunity for revenue generation and margin expansion and multiple expansion as well. When we start to see those opportunities, the multiple expansion means we say that's not the fundamental necessarily. That's simply the investor like myself starting to see the light of future potential and paying more for those potential earnings because we see the light and the transparency of that future potential. Long story short, I still find the valuation attractive on equities across many, but it takes more of a selector to capture those.
So valuations have increased a fair amount, it's fair to say, in the Magnificent Seven. But you think the rest of the market, there are bargains or attractive valuations to be found, even if they're slightly above average valuation, that can be justified. Tell us about, okay, so you said you had 30 or 35 stocks in that equity portfolio. Tell us about how you think about return attribution. Do you think of, oh, it's going to be, 1 to 2 stocks, or maybe 5 to 7 stocks is really going to generate the returns, and the rest of them I'd be happy if they went nowhere. Whereas maybe in the bond portfolio, your average bond is paid off, and it's the exceptional stocks that go badly, whereas exceptional bonds that turn out bad. Whereas in stocks, it's the exceptional ones that turn out good.
I spent my life and career oftentimes building out allocation models and going through the structure and understanding that. And as with my allocation hat on, allocation effect, that means your exposure to not the idiosyncratic, not whether IBM does extraordinarily well and is able to cut costs and realize better revenues, but whether the market goes up or down based on what the Fed does or what oil prices do or end consumer demand is generally doing and the growth of the US economy. That's allocation effect. And allocation effect is generally, call it 70 to 80% of a stock's returns. That does not mean that the only thing you're really invested in is this allocation effect and whether the stocks go up or down. We know there's a beta, which is kind of allocation effect when you've got a beta of 1.1 and to the S&P 500, and the S&P 500 rises 1%, you expect to go up 1.1%, whether or not the stock is doing better or not. That's kind of an allocation effect. That doesn't mean you're just totally exposed to that. As an allocator and as a macro aware person, then I want to either embrace those allocation effect pieces or reduce those allocation effect pieces where I either don't want to be exposed or I don't believe in a thematic, and focus then as much as I can on whether IBM is going to be a great contributor. So that's part one of there's a difference in your attribution between allocation effect and selection effect. Allocation effect is large, but you can either compress that and focus on idiosyncratic or selection effect, or you can embrace some of that where you feel like you have decent insight and feel like there's going to be a turn in the economy, for instance, and it goes further. And that's why we talk about whether my equity exposure may be larger or smaller. The second question you asked was around really around diversification and whether it's 1 or 2 stocks that represent a large return opportunity and the remainder are effectively the allocation effect, or I just expect them to keep up with the market, if you will. I don't think like that. I think more every individual opportunity we hold, we only hold 35, and we have a range of how many we hold, but it's going to be high conviction and smaller for let's say this flagship income opportunities fund. From that perspective, then we want to hold each individual opportunity that represents a good upside. And the way we think about it is we have analysts that go through and do the subjective analysis. We use the objective data to help inform our decisions. And then in the end, it's really, I like those places where we feel like we can add subjective characteristics to it and say, actually, I heard the CFO talk and I spoke to him directly, and my understanding is a little bit different than what the consensus understanding is. And I believe that they have found a new path for revenue generation that is X. That is on each of those individual things that leads to something like a discounted cash flow analysis, or that allows us to establish a price target. So every individual stock that I hold would have a 1 year, a 3 year, and a downside price target. The downside to me is a very important and underappreciated metric. No pun intended on the underappreciated. On the downside, if you look at a street side analysis, many of just the straight investment banks or the street side analysis will just show you a straight price target, where I want to know what can go bump in the night. I want to know when that aforementioned project that we heard the CFO talking about doesn't come through, and it's highly expected that it's going to come through. How bad is that for the forward expectation for the price target? And then that's something we can monitor. So we're looking for an upside, and we're actively looking to say, what might a downside be? And me, as an old physics and math guy, then I pull those two things together to an expected value. And I'm looking generally at a great expected value across my individual holdings. So back to the original question of, yes, we've got the allocation effect in the portfolio. We aim to get that right with good asset allocation, with macro awareness. And then we've got this high selectivity and this high conviction. And I want the best expected value that I can compare apples to apples with other assets, whether they be bonds or equities, and deliver the best risk-adjusted reward to an investor. But that's more idiosyncratic across each individual selection.
Do you change or adjust your 1 and 3 year downside scenario with volatility of the broad market as well as the volatility of the stocks?
To a degree, yes. I mean, the volatility of the stock market or the risk premium of the stock market may have effects on riskiness and discounting of a stock. And so there's a change metric there that, as we go through and review, it doesn't normally change the expectations of the realized cash flows, but it may change the attractiveness of those realized cash flows. So we are monitoring a risk premium of the market to help inform us. But by and large, that's the rising or falling tide that lifts or drops all boats when you do the analysis. And when I look at apples to apples analysis of my expected returns across a whole lot, then maybe what differs is the near term or long termness of those cash flows. Long term cash flows may be discounted at a higher rate, a higher risk premium, and may become less attractive to more value oriented, cash flow generative in the near term type companies.
Thanks. And tell us about your view on breadth in the market. I hear, and I wonder, is it true that it's only the Magnificent Seven that's been leading the S&P 500? It's been a narrow rally. How true is that? And then, what are your thoughts on whether it will broaden out either by the stock market going down or by the rest of the stock market, not including the Mag Seven, participating in the appreciation?
We did see a lot of narrowness. Are still seeing some of that narrowness. And when I say narrowness, what that means is, for example, up until October 27th of last year, I remember because it was my birthday, when we saw the turn, up until October 27th of last year, year to date, the S&P 500 was up significantly, on the order of 13-15%, while 493 securities in the S&P 500 were down on the year. With 7 stocks that comprised all that. That's narrowness. You've got 7 stocks that are driving everything. And we do have to recall those 7 stocks aren't small. They are 30% of the market capitalization of the S&P 500. And a smaller amount, but still a large amount of the revenue generation when you look at the underlying of the S&P 500. So these are large companies, and there is some statement. But it was an overly narrow driven rally last year. And we're still seeing some of that, where we see a lot of market appreciation, more market appreciation in the Magnificent Seven. And as we get some drop out, it becomes the Super Six, then the Fab Five, and maybe next it's going to be the Fab Four, whatever it's next.
Magnificent One.
Down to the Magnificent One. Yes. Right now, we still see a bit of that narrowness. I believe very much in a long-term broadening. I think that is a cyclical component. It doesn't mean that these large companies can't continue to perform. And if we see a downturn in these companies, a downturn in the economy or a downturn in the markets, some of these companies could represent a value for somewhat of a safe haven. They have generally lower debt metrics than many peers. These are more oriented towards technology, which oftentimes is lower in borrowing or leverage because they have lesser known cash flows. So that's one read on it that I have. I do see the broadening, and part that broadening meaning others will participate, to use that poor economic term, that poor political term. The trickle down effect should benefit many of those. And let's go back and remember that the long-term innovation and lifeblood of our economy in terms of employment and new revenue generation isn't these larger companies. It is small, mid-cap companies that find opportunities, take risk, and find the areas of the market and the US consumer that then they gain from. I believe that the innovation that has led to some of this market appreciation of those 7 stocks, those 7 companies, will benefit many of the companies that are in that, whatever we call the 493 remaining. It's going to take some time.
How common is it for breadth to be this narrow, and also for the earnings breadth to be this? I mean, Nvidia has more than doubled its earnings. All the Mag 7 stocks, except for Tesla, have done quite well in terms of earnings. So some more than others. When you study history and you learn from running the data from the 70s, 80s, 90s, how common is this, and how does it usually end out?
Great question, because this is cyclical in many respects. Breadth itself, or that factor, is a somewhat of a cyclical factor. We see the aggregation of profits in an individual sector that then broaden out. We saw that in the energy sector that then broadened out. This one, I believe, is even more cyclical in that the potential that has been flagged by these 7 stocks, or in a lot of ways, Nvidia, that is one of our best macro indicators right now. It almost must lead to broadening for them to realize the sales of all of the expected activity that they're signaling in their earnings. So I see the cyclicality. We are very wide right now in where that breadth is. It's a big difference, or we're far out on the standard deviation spectrum. Maybe a best way to look at that is the differential between value and growth stocks in some respects. They form a smaller portion of the growthy stocks, but growth stocks have been a significant outperformer and it's near a 2 standard deviation outperformance over value equity over the last, I think it's 5 years. So it's a significant outperformer, but that's a cyclical factor, and we will see that come back when cash flows become realized and either some of the new revenue generation potentials become more transparent or even realized in the cash flows. Then that becomes a cyclical factor. The second one you addressed is earnings, and whether earnings themselves on the breadth, and it goes very much hand in hand, I believe, on that. We are seeing narrowness in earnings as well, that we've already started to see normalize. And you have to only look at this earnings cycle. We saw an earnings cycle last year. We saw 3/4 of negative earnings growth last year. That was our recession. We're coming out of that now. And if we look at just this earnings cycle that we're finishing up, we're near finishing here, we are seeing considerable better earnings on a median basis. So companies are starting to project better potential, and companies are starting to show better than consensus earnings. And while we are still seeing good earnings from the Magnificent Seven, it's not just them. It is Toll Brothers out today with home building activity. That's a broadening that we're seeing in earnings. And I think that will happen sooner than we see the realization in the market.
Isn't the old adage that stocks lead the earnings cycle? What is the reason you think that this might not, that this time the earnings cycle would lead the stocks?
I think right now it's partially because it's very growth and future oriented where this breadth is, meaning this is in Google and Nvidia and IBM and Apple and Microsoft and Tesla. These are in stocks that have a much further earnings paradigm. That breadth is going to be realized more in value. So when we see an expansion, it's going to be expansion more into nearer time cash flow realization. If it were just a straight comparison of like the energy cycle of old, where we saw much lower, much more narrowness in the from the energy sector, then yes, I think that you probably see stocks start to lead because we're all about the same cash flow realization timing. Now we're talking kind of cash flow differentials between growth and value. Because we're so growth oriented, I start to think that we're going to see times like now something like a Toll Brothers, which is much more near term cash flow profile oriented, that's going to lead the profile of the market. But we'll see.
Thanks. Adrian, you're talking about the timing of cash flows, and that's the concept of Tesla. Most of the money they're going to make, is going to be after 2040, whereas a coal company, like, they're probably, they might be making the most money that they'll ever make. They're probably not going to be made not even exist in 2050. But who knows? So that's a concept. I'm familiar with that concept in the equity world, but it's so much less rigorous than in the bond world, where okay, you're going to be paid a coupon semi-annually for 10 years. You can mathematically, to many decimal places, identify your duration and how much the bond price is going to move with according to a change in interest rates. With equities, it's like I'd never have done the work but I don't even know if people attempt to define that, thinking of sort of Tesla versus the coal company, because in 2022, as I'm sure you were aware, there's a narrative of interest rates are rising and it's going to hurt growth stocks. And I mean, anytime bonds sold off, the Nasdaq sold off well, alongside it. But this year, I mean, the growthiest names like Nvidia have soared, and AI stocks, which are all about the future, have soared as interest rates have remained high. So, is there, as putting your physics quant mathematical hat on, is there anything there when it comes to the concept of equity duration?
When we talk about equity durations, this is an old school fixed income guy as well. That's a modified or a Macaulay duration, and it has a very specific formula. And then when we talk about equity duration, it's always equity empirical duration, meaning could be here, could be there. And you're exactly right. That's a conundrum we've seen. I was just talking to somebody about the artificial intelligence investment cycle and whether companies will be more reluctant to invest at higher rates than they were. And that's kind of the same discussion point of what's happened with growth during times of rising rates now, when it's done extraordinarily well. You've seen these 7 companies, and I generally think technological innovation and the potential has well outstripped the discounting effect. The discounting effect itself it's empirical as it is. Less transparency in cash flows, and you're discounting cash flows that have ill transparency. It doesn't always work over a full cycle. It's empirical. As the mathematician would hate it, the physicists love it. And it's kind of how I think about that one. But the companies now, are they worried about investing in AI? And are they going to wait in investing in AI because interest rates are relatively high to the past 10 or 15 years? No. I think the same thing in the market cycle. They're not going to wait because they can't. They're forced into it. This is technological innovation that they almost have to be a participant in, or at least have to have a strategy for participation or non-participation. And so we're seeing similar in the market, where I think that the technological innovation outstripped the narrative of higher discounting on further cash flows. If we hadn't had all of this, if this were just there was nothing new happening in the technology world at large, and rates went up, then generally you might expect to see the triple Qs drop, the Nasdaq drop. That's just not what we've seen, in part because technology has outstripped that effect.
Sorry to interrupt. Just want to tell you about Blockworks' upcoming crypto symposium in London, the Digital Asset Summit, which is running from March 18th to March 20th. Everyone in crypto is going to be there, not just the experts and policymakers, but the real industry leaders writing the checks. Over $800 billion in assets is going to be represented. Anyone in crypto is going to be there. So if you're into crypto and you haven't bought your ticket yet, the time is now to get your ticket. I would not wait any longer. We've got some exciting guests on the macro side too. Julian Brigden, Michael Howell, and yes, I can confirm at last, the rumors are true. Joseph Wang, the Fed guy himself, is going to be there too. I'll be hosting a panel with these macro heavyweights that you don't want to miss, so be there or be square. Click the link in the description and use code FG10 to get 10% off. Thanks. Let's get back to the interview. How does the AI bull market that probably began a little over a year ago, maybe, how does that compare to the late 90s tech bubble, .com bubble?
Some of the similarities I find kind of interesting are, well, the rapidity of this AI cycle is faster to me. The potential for adoption. We just talked about last year when ChatGPT came out in March. 8 weeks later, we had NVIDIA. It felt like the world had changed overnight almost. We had data rooms, like in a source of like 8 weeks, data rooms were becoming over capacity because of adoption of new technology was leading to problems in data rooms. That was a big transitional change. The actual effect, it kind of feels like back when something like Google was introduced, and I don't know if you're old enough to remember, but people used to send around these links that would say, you'd say, "What? How do I find something?" And you'd send around a link that would say, "How do I Google how to find a restaurant?" And it would take you to Google and it would write it in there for you. And it was before people really understood and they were nervous about it. We're somewhat in that same phase now of artificial intelligence. Sounds cool, wild, and crazy. It's great, but really it's pretty simple. Just go to chatgpt.com and type in your question and you're using AI. And I think a lot of people don't realize that we're still in that phase of people aren't sure where to find the efficiencies, if they can find the efficiencies, and if those efficiencies are useful, and they don't trust those efficiencies or those new ideas. It's about the same on that bit. I think this is more accelerated. I think this is it's as impactful. I mean, that paradigm created visibility and access to a range of services and products, which previously had much harder time coming to market. And this creates a whole new set of revenue potentials and efficiency gains for the utilities that may work for some and don't work for others. But just planning your vacation rather than spending all of that time going to Google and researching what cities are in Italy and where might I stay. I encourage you next time to go to Bard, or now called Gemini, or ChatGPT, and type in, "I've got 5-day vacation with 2 kids that are 14 and 12, and I might take my mother-in-law, and I want to stay mid-range and go to Italy," and it will lay it out for you, and you can pretty much save about 5 hours of your life researching things and book your vacation. So whether it's personal or professional, there's efficiency gains to be had, and I think we're in a bit that same adoption cycle. I think this is faster than we have seen before. I am uncertain still on the revenue realization potential that is out there. I know it's there, and our job is to go find areas where either, as I said, efficiency gains or new revenue potential is going to help companies, or as you mentioned on the bond side, if it reduces their default risk. In some cases, it may be the opposite. If we see companies that get scared and over lever to adopt technology they don't know much about, would that lead to issues on me as a bond investor of the only thing I'm really worried about is them paying back their bonds, not the upside. So as a bond investor and an equity investor, certainly I'm thinking about those historical paradigms and where it comes out. I think it'll lead to a lot of opportunity for astute investors across the value and the growth paradigm. These aren't just growth companies that will benefit. This is, you look at Lowe's, the home supply store, they've got the Lowbot that you can go on and it helps you identify new projects in areas of need. And they've got another artificial intelligence piece that they've been adopting that looks like they are going through and optimizing how you might view products on aisles and where you might purchase further and how they might best serve their consumer that will help them. And it's not a new product line. It's not necessarily an efficiency. It's just improving their business. So whichever growth or value, I think we're going to see opportunity, hopefully not overspending.
Got it. Thanks. Earlier, you talked about fixed income allocation. I think you said you were reducing your credit risk, but maybe that you were adding your duration risk. Why is that? And is your view to go further out in the duration risk? Does that imply that you think the Federal Reserve is going to cut more than it's priced in?
Sure. Credit risk is an easier one to look at. We talked about that a bit on just generally finding not enough compensation for default risk, which is more systematic in nature generally, especially for high grade companies, and finding more of that potential for capital appreciation in the equity market. And then interest rate sensitivity or our duration. We started to see a lot of the turn last year, at the tail end of last year. As I said, it really kicked off on my birthday, on when interest rates started to drop and dropped significantly for the fourth quarter of last year. We had added a little bit of duration right now we are, I don't know, we're sitting about neutral on our overall target for interest rate duration. The Fed itself, what I generally tell investors and believe for a long-term environment, we talk a lot about, oh my gosh, is the Fed going to cut rates in March or May or June? And, or, some like Larry Summers recently even discussed, well, there's a 15% probability that the Fed could come back, turn tail and hike rates. I don't believe that. I think they've communicated pretty well. Chairman Powell going on to 60 Minutes and telling the market directly, really the next move is we're going to cut rates. He didn't say that directly, but it was pretty close. So we've started to see that narrative shift pretty strongly, that whether it's March or May or June is less important than looking at the neutral rate. The neutral rate is that longer term rate, which balances their dual mandate of labor and inflation. And right now they're telling us a neutral rate, or their long-term dot is around 2.5%. That's way lower than where we are now. So we've said, yes, with the Fed is highly likely to cut rates next as their next move. Whether it happens in March or May or June is less important to me than continuing to communicate that they are going to be headed down to a neutral rate, and they can be accommodative. In any communication that we see on their accommodativeness to what I used to call the third leg of the monetary policy stool, which is the wealth effect. And the wealth effect, of course, is your 401k plan or the S&P 500 and the value of your house, meaning if markets drop significantly, would the old Greenspan put come back into force? Would they be able to drop rates to support? And whether they will, I believe they will. The important part is they can. And they couldn't do that at zero interest rates. So they've got the potential of a volatility buffer, if you will, of reducing the negative impact of the third leg of the stool, while still focusing on the long term of a balanced neutral rate that is lower than where we are now, of a neutral rate that is supportive of a balanced full employment and 2% inflation mandate.
Because interest rates are higher, they can go lower. So there can be a net loosening that the Federal Reserve has that button when interest rates at zero, it's done. I mean, they could go negative, but that's not really something I want to do. So how would you characterize financial conditions right now? Are they tight or loose? Many people, wind the clock back 2 years ago, would have said, okay, if you're telling me in 2 years, the Federal Reserve would have done a ton of quantitative tightening, its balance sheet is much smaller or somewhat smaller, and interest rates, instead of being at zero, would be at 5 3/8. I think a lot of people would say that is a financially tight environment. And yet many of the things the Federal Reserve does not control, credit spreads, equity valuations, many other things, are pretty loose. I mean, the stock market is around all-time highs. As you said, high yield spreads in that 86th percentile of very narrow spreads. So are financial conditions tight, easy, or in the middle right now? And how much does that have to do with the Fed?
I often think that if he'd done a Rip Van Winkle in 2020 and gone to sleep, actually, beginning of 2020 and gone to sleep and then woken up today and said, well, so wait a second, we've been through a global pandemic, a near war in the Middle East and a war in Eurasia, and interest rates are up by 500 basis points. Our financial conditions, well, number one, you go, where's the S&P? And you wouldn't say it's at 5,000. And number two, if you look at financial conditions, you'd say they're probably pretty constrictive right now. Gosh, that's not the case. And that's not the case. We've got companies that are opining with their feet in the first month of this year, first 2 months of this year, really, on corporate issuance and saying, we're going to come to market and borrow for one part, to extend out their liabilities so we don't end up with a credit crunch in 25, 26. Still a possibility, but extending out those liabilities. And two, they're financing projects. And if they are buying companies and financing projects by borrowing, they're opining directly with their feet to say forward returns on these projects are higher than where they're borrowing. And so at elevated interest rates, we're still saying we see decent nominal growth in the economy. That means financial conditions can be not just constrictive, but they can be more open, and I believe they are more open, even though we're at a higher rate than we've been over that portion before 2022 for about 10 years. I see open financial conditions right now and reasonably strong financial conditions. The interest rate is higher. That causes some consternation, but so is nominal growth, number one. And that nominal growth is, relative to the interest rates, the companies are opining and saying that they're taking advantage of that to experience longer term nominal growth for those projects. And, we see a housing market that is surprisingly resilient so far. I would say, I'm probably not alone when I say I'm actually surprised we didn't see more of a drop down in the housing market nationwide when mortgage rates went up to 8%. They're not there now. They've come down and the market responded okay. Maybe there's, we could use the excuse of there's lower supply in the housing market and lower mobility because of other areas. But that was, something that was telling us anyway that the financial conditions, as told to us by those that really are taking advantage of them for either borrowing for new projects or not, are still reasonably strong. I monitor about 5 different financial conditions indices because it's a really great way to try and measure when you might see systematic risk emerge. When financial conditions closure happens, if we were to see bond spreads widen significantly, lenders like myself in the market say, I'm going to step back and I'm not going to lend as much because I forecast that default risk is going to go much, much higher. At the same time that U.S. interest rates are rising, and so companies are not able to roll their liabilities, and then we're seeing problems in the equity market and the IPO market, all areas that we've seen a little bit of, but maybe on a rolling basis. We see that all at the same time. That leads to systematic risk, and that often is one of the precursors of what I'd say is a large drawdown, is when credit market sees or financial conditions sees. So we watch that very closely for the sharp turns.
And you don't see that now?
Not at this point, no.
So you said an income-focused fund is the flagship fund. How does it differ when you're seeking out equities that pay a dividend from a non-income oriented fund? And I imagine that mean that you're precluded from buying, for example, Berkshire Hathaway, which does not pay a dividend. And how does that kind of shape the investing process?
Yeah, good question. We're not necessarily precluded from buying something like a Berkshire Hathaway, which surely one day they will pay a dividend. But you're right, they don't today, even if Mr. Buffett tells us they never will. We are looking for capital appreciation, and you're right that there are different constituencies here. There are those income funds that are really pushed into just the high dividend yields, just the best places for income on their corporate bonds or high yield bonds, and it leads to a big factor bias or more allocation effect and more correlation to the overall market. And then, of course, you have those funds that don't have any paradigm at all, and so they have less of the income buffer, but they are probably more growthy because that now forms 30% of the S&P 500. That's just a large portion of the market. We are, I'd say, more income oriented, but we aren't forced into the highest dividend yields. We are looking at areas where if there are companies, we used NVIDIA as the example, they pay such a small portion of a dividend that it's not really meaningful, but they do pay a little dividend. We looked at them, we held them for a bit, and we experienced a great capital appreciation from NVIDIA, in part because what we're looking for is good income generation, but if we find great opportunities for capital appreciation, then that's a second leg of our stool. And our third leg of the stool is, as I talked about, having a downside analysis or a downside target. That's how we think about the market. Of yes, income is very important, and for that flagship fund of what we're trying to achieve, capital appreciation is also important. So I'm not picking companies simply because they have a high dividend yield or a high dividend coverage or a growing dividend. All those things are important when you consider a dividend. But I want to see capital appreciation. I want to see a potential for the company to do well and to create new efficiencies, to expand their margins, maybe to expand their multiple, to have new revenue generation that the market doesn't expect. You probably hear a lot of those things over again. Of these are the things that we're looking for to deliver good free cash flows and elevated free cash flows, ideally over what the market expects.
Very interesting. Well, Adrian, thank you so much for coming on Forward Guidance. It's been a pleasure to hear you share your views. And thanks everyone for watching.
Likewise, thank you for your time.
Thanks for watching. Remember to check out vaneck.com/HODLFG to learn more about the VanEck Bitcoin Trust, ticker HODL. A reminder that Forward Guidance episodes are available on all podcast apps and on Twitter, where I post them regularly at JackFarley96. Thanks again. Until next time.